Good morning, everyone, and welcome to the first episode of our new webinar series, Plan B. Throughout this series, we'll be looking at the benefits that specialist finance can bring when your initial Plan A isn't available. So if you think of a Venn diagram with two circles, prime on one side, and specialist on the other, the real benefit for us in this conversation is that intersection, which seems to be growing ever larger as the specialist lenders continue to innovate. By the end of this session, you should have a better understanding of what specialist lenders are looking for, when to turn to one, and how they can help your clients, both mainstream and other, and also give you a better outlook on the buy-to-let sector. So why and when should a broker look to specialist lenders for buy-to-lets, and what does that process and what does that journey look like? So for those of you that have joined us before, you'll be familiar with the Q&A button at the bottom of your screen. For those of you that are new, please take advantage of that. These sessions are more interactive. If you're involved, you can fire us your questions, anything that's on your mind, anything that the panelists mentioned that you want to dig deeper, please raise that through and we'll do our best to cover them off today. So in order to help us understand this sector a bit better, I'm joined today by two expert panelists. I'm delighted to be joined by Chris Daly, Managing Director of Specialist Mortgages at Hampshire Trust Bank, and Sally Precious-Ward, Intermediary Sales Manager at Together. So, welcome.
Hi.
Morning.
Good morning. So Chris, let's start with you. Can you give us a quick introduction and background in the industry?
Yeah, sure. So, as you said, I'm managing director of the specialist mortgages team here at Hampshire Trust. So we do specialist buy-to-let, semi-commercial holiday lets, PBSA. So anything kind of investment based, and we also have a bridging and development team here as well. My background's really varied, always in banking. I started at Lloyd's and did lots of different jobs. I worked in the branches for a while. Then I worked for the exec and did lots of credit roles. And then I decided I want to work in real estate, and I've worked in kind of specialist or challenger banks since. So I worked at Metro Bank, I worked at Secure Trust, and then I joined here about 18 months ago in the middle of the mini budget, which was fun and exciting. And so, yeah, been here 18 months. We're a team of about 65 people now, kind of all based in the City of London.
Thank you. Sally?
Hi, yeah, I'm Sally Precious-Ward, and I'm an account manager for Together based in the south of the UK. Similarly to Chris, been in the industry quite a long time with a variety of roles. Started off my sins as a financial advisor, then mortgage broker. My introduction to the world of being a BDM was with Mortgage Express, who were nationalised back in 2008. So seen a few crises in the industry in my time, and particularly working for that lender at the time. Then worked on their back book for a while and came across Together 4 years ago. And also similarly to Chris, joined at an interesting time. So I joined 2nd of March 2020, and we all know what happened a few weeks after that, so don't need to mention it. So yeah, interesting start to Together, but yeah, been here 4 years now, and yeah, I'm delighted to be here to be chatting about everything that we can do and help the brokers with today.
Excellent, thank you. What's a bit of a theme going here? So I joined Crystal in September 2007. It's a great time to enter the specialist finance space. Having previously been at a building society, and I've been here ever since. So what's that, 17 years or so now. So there's quite a substantial amount of experience on the panel today. So hopefully for the many attendees that have joined us today, please take advantage of that, fire your questions in, and we'll do our very best to help. So let's dive straight in then. So Sally, let's start with you. How was your 2023? How was Together's 2023?
Yeah, I mean, it was an interesting time, 2023, but our results are published and it was a good year for Together. But it would be remiss not to recognise that the growth did not directly correlate with growth in the buy-to-let term loan sector. So it was a difficult year for some landlords, but I would add not for all landlords, because there were opportunities then within the market. And the joy with Together is that we've got a wide product range. We've almost got a product for everything. So where the buy-to-let term lending maybe dipped, we were able to support brokers and clients achieve their property ambitions through different types of lending. And I would particularly mention bridging in relation to that. So where clients were looking to obtain property quickly that was maybe competitively priced, or make some amendments to their portfolios and generate better rental yields, we saw an uplift in bridging, which in turn will then support the buy-to-let market because they've borrowed on that kind of temporary finance basis instead. But totally appreciate it was a challenging market with interest rates and a lot of adjustment needed from property investors and from brokers to get used to the new environment that we're now working in.
Thank you. I think it's a fair statement. It was definitely a challenging 18 months or so. Chris, how's your initial period been at HTB, and how was the last year for HTB in particular?
So the way I keep describing 2023 is as a roller coaster, and I think, frankly, everyone in the market probably feels the same. Although I think we've probably all been on this roller coaster in one form or another for the last 4 or 5 years. So I don't know when the roller coaster ends, but look, for us from a kind of a buy to let perspective, we actually had a pretty good year. We spent the first month of 2023 just kind of finishing off. We committed basically to all of our pipeline post mini budget, and so we spent that first month just getting those deals done and getting our kind of underwriting queue cleared. So we came back to the market really in February with our pricing, and so we kind of compressed from a standing start 11 months performance into a year's target. But so our results aren't published yet, so I can't get into too much detail, but for us it really was a strong year, and I'm really proud of the team and kind of what we've done. I think kind of by my own back of a napkin calculations, I think we broadly doubled our market share, partly because the market shrunk and we continue to grow, so it's slightly flattering. But I think to Sally's point, we also have a very broad church of products, and I think that really helped. So we saw a big uptick in higher yielding asset applications, so more holiday lets, more semi-commercial, more HMOs as kind of borrowers were seeking yield, seeking serviceability, and much less in kind of your vanilla buy-to-let space. And I think that kind of saved us a little bit in terms of having that broad range.
Thank you. And how's 2024 started so far?
For us, really well. Really well. Fantastic first couple of months. We came into the year with a pretty good pipeline. Kind of the volume coming in the door early on is really strong. I think one of the most reassuring points so far is not only is it coming in the door, but it's actually progressing. So we don't ask for any commitment from our brokers or our borrowers prior to them paying a valuation fee. And so our pipeline can ebb and flow in terms of conversion rates and timeframes, and obviously we track that, but we really are seeing commitment at the moment, and back at kind of long-term levels, and that's great to see. But it's only the 20th of March, and I'm still nervous we're on that roller coaster, right? I don't believe that it's stopped and we're off, and we're off for lunch kind of thing. So really positive. I was at the Mortgage Business Expo, for example, yesterday, and then kind of lenders were saying similar things. So it's looking up. I think we all just really want a period of stability and certainty.
It's something that's been lacking for a while, and we'll cover it off a little bit later, but we've got a general election coming up. We've got numerous changes on the horizon as well. So as much as we want stability, let's see how that progresses throughout the course of the year. Sally, how's 2024 started for you?
Yeah, again, like Chris, we had a really good start to the year. I think since this is my opportunity to promote Together on this as well. One of the highlights for us has been the launch of our second market report, which is called Opportunities and Outlook in the commercial space. And we're really delighted to bring this because it's a good tool for brokers to use in talking with their clients, for packages to use in talking with their brokers. And the report highlights and demonstrates really how we want to continue to support the market. And we're already seeing this with, again, similarly to Chris, higher yield properties. So we're doing lots of social housing lending with clients getting involved in that sector, maybe HMOs, multi-unit freehold blocks. And the joy with those as well is when you're providing accommodation for a vulnerable tenant sector, it's got a feel-good factor about it as well. Bridging has massively increased. I mean, we're writing about £130 million worth of bridging, or lending 130 million. We were about 80 million this time last year, so that's a big uplift. And a large proportion of that, again, is related to the buy-to-let market, with property investors converting existing single unit assets and making them higher yielding by maybe converting them to an HMO. So yeah, we're seeing lots of different transactions, a really positive start to 2024. And I think it's about seeking what the opportunities are. We're on this roller coaster. We're not back to historical times where the interest rate market has been flat and the people are coming to you with this, I'm going to buy this investment property, please can you arrange the mortgage. It's actually having wider conversations about how you can support experienced landlords in being able to progress their property portfolios.
Yeah, I think it's a good point. I think one of the big wins for me with specialist finance is it's more of a solution driven process rather than kind of have that product and you go and get it. It's not transactional as such. It's more, this is what I want to achieve. How do we get from here to there?
Yeah, absolutely.
Leads nicely into the outlook. So 2024 started well for both of you. Sally, what's your outlook for the rest of the year and beyond, especially in that specialist buy-to-let space?
Yeah, I think we're likely to continue to see some smaller landlords are going to exit the market, but that in turn makes way for more experienced landlords to potentially be scooping up those purchases to expand their portfolios. There's going to be a continued need for buy-to-let. We've got a rising population, a continued shortage of housing stock. There's investors that are taking advantage of the temporary fall in prices of properties. We are in a more stabilised interest rate environment, so you've got a whole load of investors that were maybe putting things on pause at the kind of 2023 back end of last year, waiting to see what happened with interest rates to gain some comfort. So they're now re-entering the market, proceeding with transactions. And there's also lots of evidence of diversification in portfolios going ahead. So I talked already about converting to HMOs, but maybe buying semi-commercial properties instead of single unit AST properties, or getting involved in social housing, or making conversions, changes to properties so that they get these enhanced and improved rental yields, which are going to be needed to be able to meet requirements of affordability for ICR requirements with lenders.
Yeah, that's a good point. I was just looking for it, but I can't find the figures offhand. There was an article released, I think it was last week, talking about the number of fixed rate mortgages that are coming up for renewal this year in the buy-to-let space.
Yeah,
there's a large number of landlords there that are going to see an interest rate shock when that comes to an end. And as you mentioned, the pressure that's then going to put on ICR calculations, there's going to be much more need for a specialist solution than that if these people can't access mainstream funding.
Yeah, absolutely. But likewise with that, I mean, one of the stats that was in our report was, I think it was 59% of landlords plan to increase their rental that they charge this year, and the average increase in rent was 24%, which sounds quite significant, but is necessary in order for that to be sustainable and this ongoing demand for rental properties, because you've also then got first-time buyers that have been put off buying properties because of interest rates that are going to continue to be in the rental space. But again, that's not going to be at historical rental prices either.
That's a good point. Thank you. Chris, your outlook for the coming year?
I am very much a glass half full kind of guy, and therefore I'm going to say it's going to be the best year we've ever had, because we need some positivity, I think, in the market. I think if you look at all kind of the key indicators that we would look at, they're all better than where we thought they were going to be 3-6 months ago. I think there's more positivity in the market. I think if, to Sally's point, we've kind of got a glide path on interest rates, so at least people can make investment decisions again. We haven't seen, the arrears or the end of fixed term issues that we thought we might actually. So I think, brokers working with their borrowers have actually done a really great job of, what's coming down the track, because we're at a point now where rates have been high for, 15, 16, 18 months. These aren't shocks anymore. These landlords have known what's coming. So what we are seeing is adjustments to portfolios. To Sally's point, we're seeing stuff come out of our bridging team. Maybe they're kind of retail conversions, etc. We're seeing rebalances for semicoms, all that higher yielding stuff I discussed, but we are also seeing some property sales. But the stuff that's being sold is your vanilla, southeast of England C3 residential stuff where the yields just aren't there. But that's good. That's positive in our eyes. That's churning stock over. Maybe some first time buyers buy that. That supports sentiment. That means you get a positive news article in the press on the weekend, which one of your borrowers reads and decides to go and buy his next property. Like, it all really starts to feed into this positive cycle of what the world can look like. So our house view is, we've had a great Q1, not the standard seasonal Q1 you'd really expect to have, right? You'd expect January, February to actually be relatively quiet. But I think the spring and summer, are looking really positive. I'm sure you'll all remind me of this in 6 months' time when something's happened, but I'm going to stay positive, just in case I'm correct.
You're right. The industry does need some positivity. You pick up the paper on a Sunday morning, there's lots of doom and gloom written in there, and we seem to be lurching from one war to another, one crisis to another, one issue to another. But one thing that the housing sector is showing is resilience. People do want to look after their properties, even going back 20 years. It's been a good sector. It's been a strong performing sector. It's a phrase the Englishman's home is his castle. I think we're seeing it coming through from there. Are you seeing any particular trends in new applications coming to you? Maybe anything unusual or anything that's surprising you?
One thing that still continues to surprise me is our uptake of our high fee products, and I know kind of they can be controversial in terms, some brokers can see the benefits and some are not a big fan of them, but we introduced that when there was the shock in affordability, yields were kind of catching up, rates were high, but customers are still very much wanting to take them up. And that, I think that's quite surprising. Obviously, we build products to meet customers' needs. And as long as that kind of maintains, then we will keep that. I think the other thing that still surprises me, and I know there's an affordability angle here in terms of stress rates, but still how many people are taking on 5-year fixed rates, given where we all think rates are going. I thought we would see more people maybe short-term deleveraging, hitting the stress rate on a 2-year or a variable, and taking that shorter term view, but people still seem to be very, very keen to lock in to 5-year money at the moment. Just a bit of a surprise. Other than that, it's the kind of the point I'd said earlier. We are still seeing more higher yielding stuff, so more holiday lets, more HMOs. I'd be very intrigued with the stuff that came out of the budget regarding furnished holiday let allowances, whether that makes any change to demand for holiday lets and that kind of serviced accommodation space. But I think they're kind of the main trends from our side.
That's an interesting point about the furnished holiday lets. So we had a client pull out of 3 purchases the day after the budget because he'd planned for his limited company model to do plan A, and then as soon as that budget change was mentioned, he said, "Well, I'm just going to pause on that because I don't know how that's going to impact my model moving forward." So I think that could be an interesting one as we progress.
Yeah, I agree. And I think one of the things that maybe lenders aren't talking about enough, and certainly brokers should be aware of as well, is that there are, for the banks amongst us and the lenders, there are incoming capital changes. So the PRA are consulting on the moment. It's expected to come in from sort of July next year. Will actually triple the cost to banks for lending against holiday lets, and that is going to start to impact rates. So all of a sudden your rates start to go up. They start to look like commercial rates. You've lost a lot of the tax benefits of doing a holiday let. So all of a sudden that gross yield you're getting starts to look pretty measly on a net basis. And I think that's one of the things kind of, I hold my hand up to that I really want to start talking about more with our introducers, because it is something that, again, back to investors being able to make long-term decisions, that's something that is coming down the track, and people know about that.
Interesting, thank you. Sally?
I mean, I would, since budget, and it's only a short period of time, but for me personally, I've seen a drop in holiday let enquiries. So it is almost like there's this knee-jerk reaction to anything that's announced like that, while people just take stock and decide what it's going to mean to them. But where we see particular trends at the moment, so multi-unit freehold blocks seem to be a very popular choice, particularly with Together. We don't have a limit to number of units within the block for it to be on residential rates. So I see people are particularly buying those. Again, yields better. Semi-commercial improvements and increases on that side. A big uplift actually in second charge buy-to-let lending as well, where landlords are now accessing equity within the portfolio. So taking your point that there's a huge amount of mortgages coming off fixed rates this year, there's still a significant amount of mortgages where people are tied into good interest rates with early repayment charges, but have got equity available and wanting to move forward with their portfolio and grow it. So second charge buy-to-let lending seems to be a very popular choice for clients.
One thing investors tend to show frequently is that innovation, isn't it? They look for the next thing and they're quite quick to move to that. So where people do have equity tied up, there was talk recently of EPC changes, which who knows when that's going to come in. So our landlords gearing up to improve the properties ready for that point, or are they just unlocking capital for other opportunities? Interesting.
I think it's the difference between a professional landlord, though, or professional investor versus your more amateur investor, because a professional investor will have a vested interest in making sure that their properties are well maintained, well managed, and therefore EPC is potentially going to be less of an issue for them because they would be keen to make sure that those properties are in a good state of repair. And if I think back, you've really got a whole generation of investors, but also mortgage brokers that have been used to interest rates being at this flat low level. So they've had the benefit of monthly rental yields and capital growth from the property. Whereas if I think pre-2008, people invested in property, but they invested for long-term capital growth and not for monthly yield. So it's having that adjustment period again, where people get used to why they've got a property investment, what their plan is, that maybe it's no longer the double win that it used to be. You don't get the yield and the growth, but if you're in it for the long haul, then you would like to think with the property market, it's always remained buoyant, it's always remained positive, it's always come good, that the long-term capital gain will be beneficial.
Sally, you just raised a really good point there, actually, around kind of like being in it for the long term. And I think that's a really good point. I read a report the other day in one of the papers around a lot of the landlords that are leaving the market in the last 12 months are landlords that entered the market during COVID.
Yeah.
So they are people that got the, kind of sat at home bored, thought this looks fun, that's something to do. They didn't buy Bitcoin or whatever else, they went and bought a buy to let. And then, as experienced landlords know, have realized that it's actually a lot of hard work and it's a lot of responsibility, and are selling up. So a disproportionate amount of landlords that are exiting the market only came into the market a couple of years ago. And actually those, to your point, the really experienced ones, they knew that it was hard work and they're in it for the long haul. So sometimes when we talk about landlords leaving the market, there's not to say good and bad, but there's do you know what I mean? There's kind of some are a real loss to our profession, and some are kind of never really there in the first place.
Yeah, absolutely.
Yeah, that's a very, very good point. So Sally, sticking with you for this one then. So the word specialist, looking at Plan B now in particular, word specialist can invoke many different reactions. How do you see the relationship between your products at Together and the mainstream?
Oh, I think it's probably safe to say that we are not a direct competitor of the mainstream space at Together. We lend where others don't want to lend, and that will either be based on type of client, type of property, or something to do with the income structure of that property. So really we're there to support where lenders are not willing to lend, or they deem that transaction too risky. And sometimes the risk might be pretty negligible. So it could be something, I had one across my desk the other week, and it was the fact that this property was across the road from a commercial premises, which to Together would not be an issue whatsoever, but this particular lender did see it as an issue. Or it might be that there's insufficient background personal income. But sometimes the additional risk is way more apparent. So for example, I don't know, first-time buyer with no experience buying a concrete construction house and wanting to put it on a social housing lease, or it could be a combination of many factors. But I love calls like this where you've got a combination of lenders and not just, I love to promote the Together things, but it's good because I always say that there's plenty of space for us all to play nicely in the specialist lending arena, and we're all doing different things. But brokers don't need to be experienced in all of this complicated criteria that a specialist lenders do. I always say they just need one good relationship with a packager, with Crystal, for example, because then how you can support those particular transactions, because it's a very, very different sector to mainstream lending.
It is. I mentioned I joined here from a building society previously, and my first week at Crystal, I was basically looking at cases and saying, I don't think we can do this one, but, and then the response was, yeah, we can do that. What? I don't think we can do this one, but yes, we can do that. And it was very much a case of almost changing that mindset from how do we not do a deal to where's the benefits? What can we do? How can we mitigate this? And it's a very, very interesting mindset to try and find a solution to something rather than, sorry, it doesn't fit, I'm looking away.
Yeah, absolutely. And as I say, if you're if your profession is dealing with mainstream lenders and fairly standard buy-to-lets, then you maybe don't know of the criteria. But it's just about thinking, right, rather than put this in the bin, let me just go that extra step, find out, is this case placeable? Is there a specialist lender out there? And then again, you're experienced in having that conversation, because there might be some discomfort about talking about the increase in interest rate that comes with using a specialist lender rather than a high street lender. But it's understanding that when there's an additional risk, there's an additional price, I guess it is, to pay for taking that risk on.
Yeah. Talking about trends, we recently launched our referral option via our mortgage desk. Previously, we act as a true packager. The broker handles the client, we work with the broker. But we discovered that brokers are uncomfortable having those conversations.
Yeah.
They're happy if the rate begins with historically a 1, 2, 3. As soon as we start looking at 5, 6s and 7s, well, I don't know how this is going to go down with my client. So our referral desk has become much more popular, certainly in the last 3 or 4 months, with brokers wanting to refer clients across for us to handle the wholesale for them.
Yeah.
So yeah, that's something that we're seeing our side too.
Good.
Kris, how about yourself? How do you see your relationship between HDB's products and the mainstream that some of the brokers are more used to dealing with?
I agree with everything Sally said, right? So, we pick up the deals where the mainstream banks say no, or where you need that human touch, that common sense attitude, the kind of, okay, how can we do this kind of thing? And yeah, that, as Sally said, that typically comes down to the asset, to the borrower type, or the jurisdiction, or their background, or their credit history, or it comes down to something to do with product or criteria. So, we might have a client with a really vanilla asset, typical standard UK SPV, has been with a mainstream bank, but the ICR is now tighter, or they want a lower PG, or they've got some sort of adverse credit on their file because of the last couple of years, etc. So that's really where we pick it up, and then we really escalate by saying, well, we'll do all of those combined. So then we'll do the foreign national first time buyer buying a HMO let to a housing association. And that's when it really, that's when your brain really starts to hurt. But that's where we really kick into gear. And that's where the specialist lenders really, come into their own. And yeah, I agree with Sally's point, having a packager that understands all of those nuances and criteria, and you can have, pick up the phone to one of our underwriters and have that conversation. That's what makes the specialist lenders unique.
I use the word creativity as such, but it's that relationship, isn't it, where something might not look a certain way on paper, but you can talk it through. A big difference for me between mainstream and specialist. A lot of the mainstream lenders have gone down an automatic dip route. You key it in online, and if it either passes or fails, and that's that. Whereas with both of yourselves, you can have that conversation, and I think that sometimes can make the difference between placing a case for a customer and not. So actually, we've got a couple of questions that have come in on that point now, so let's pick up a couple of those. An anonymous question's come in for a student let property, 2 tenants on separate ASTs, locks on the doors, and this broker's had it declined by 2 lenders currently. Is that something that you guys would consider looking at?
We certainly
Absolutely.
would.
Fighting for the case now, Kris.
Yeah.
Yes, we would.
Excellent. So there's one that we can do. And the second one that's just come through, would either lender accept rent to rent, not via a housing association?
So by that, I'm assuming that they mean some kind of complex lease, or where it's leased to one party who then sublet it onto another lease.
I would interpret it that way, yes.
Yeah, absolutely. With anything like that, so we will lend on non-standard lease scenarios, but we just need to see the details of that lease and understand the income that sits behind it and who's supporting. You get all sorts. Sometimes you get, I don't know, opco, propco arrangements where company A lets to company B, but it's understanding what income supports it in the background. So I would say with anything like that, the question is pretty vague. So my vague answer would be yes, we could support, but would want to see the actual structure of the lease to make sure it's got all the correct kind of mortgage clauses in it that we would require, and who the 2 parties were that were involved in that rent to rent situation.
Yeah, and we're very much the same. So kind of commercial leases, lease to a third party that's then maybe doing ASTs or service accommodation, is pretty standard for us. I think one of the pieces of advice I would give is that if you do have a borrower looking at doing that, engage with a specialist, engage with a lender early. What we see a lot of examples of are borrowers putting leases in place that then are actually unmortgageable because they don't have the correct provisions or clauses in, and actually that creates more cost and more issues and more time for the borrower. So I would just say engage early. But from our perspective, what we would do is effectively look through that lease to the underlying use. So if they're going to use it as holiday lets, fine. We want to understand what the holiday let market looks like in that area and what the kind of high, medium, lows are going to be. If you're going to let it to corporate tenants, fine. You know, who are those corporate tenants? What's the demand in that area? So really, it just comes down to who's underneath that, and really who's behind that lease, right? Because typically it's or sometimes we find it's a one-man band. They themselves maybe don't have a very strong asset and liability statement, and so we may view the lease is slightly weaker, but that comes back to your point earlier, Chris, of, okay, well, how can we mitigate that? What's the other things that we can rely on that mean that we can support this deal? And a lot of the time it's actually, well, okay, well, if you ignore all of this deal will just work on ASTs, and that's fine. And you can look at that and go, we totally respect that the borrower may be getting a lower hassle option or might even be getting a better return. But fundamentally, if this deal works on ASTs, we will sit back and look at it on that basis.
The creativity that we were talking about earlier, it's how can we make a deal work? And again, for me, that's one of the big skills in this sector. Thank you for the questions. Please keep them coming in. We'll cover them as they land. We've had a couple of pre-registered questions. One of them around AVM. So Sally, I'll direct this one to you. Maximum LTVs that lenders will consider with desktop valuations.
I can't tell you lenders, but I'll tell you Togethers, and it's probably a good one. I think we're one of the most generous ones in the market. So up to 75% on a purchase, and there's a sliding scale because 75% is to £250,000 loan size, but if it was up to £500,000 loan size, it would be 70% restricted. And on refinance, we go up to 70% using an AVM, again with a sliding scale of loan to value versus loan amount that you could use for that.
I suppose linked to that, we had a question on a previous webinar about down valuations, and this is always an emotive topic with brokers when something doesn't come in where it's expected. And there's two views on that, isn't it? Is it a down valuation or was it an overestimation to begin with?
Yeah,
it's always a grey area as to where that fits. And one of the things that was raised by a valuer previously was the fact that they have to base it on sold evidence. Obviously, sales that are going through now were properties that were agreed at previous purchase prices. So there's almost a lag between the property being sold and that reflecting on a new valuation. Are you seeing any issues with physical valuations currently?
No, can't say that I have. Again, it does come down to that old term of it being a down valuation and whether it really is a down valuation or whether somebody's property that they deemed in their inexperienced state as a non-valuer to be worth a certain amount of money, and then a valuer deems it not to be worth that amount, that is not actually a down valuation, it's a more realistic valuation. It's a really good point that you make, that there is this time lag that sits behind it. But I think also in the market at the moment, what we're seeing is it's not that prices have dropped or the market's dropped, it's almost resetting itself, that historically there'd been some overinflated prices, and that's the other thing with the property market. You can get to a point where it starts to spiral a little bit and there's some notional increase that's not actually there. But I'm not seeing major issues with valuations or clients seeing down valuations per se.
Thank you. Chris, anything from your side to add on the valuation point?
Nothing thematically on down values. You're right, there are always cases where either a borrower is optimistic or a valuer is pessimistic. I suppose from our side, we have a couple of controls there that our underwriters review every single valuation. If they believe it's been downvalued or overvalued, they will challenge it. We have internal RICS chartered surveyors that look at this, and our valuation panel providers will also look at this. So there are many different checks and balances and areas of appeal. One of the things that we do see pretty regularly on our kind of larger valuations, so red book commercial valuations, is especially on the time lag point, a valuer will go, okay, well, these are the comparisons, but they are 2 years old or 3 years old. So actually, I'll apply HPI to that pound per square foot. and go, okay, well, actually, now I think it is this as of today. So you're using the historical base, but you're using then the regional or local HPI, depending on how close you can get, to go, again, this is now the valuation today. And we have found that that does increasingly match to the borrower's expectations, because, you know, the borrowers most of the time are not plucking this out of the air. They are looking at a right move or auctions or you know, other data points that valuers can't rely on, but valuers can use that method to get to the same point.
Thank you.
It's also a point that's quite often raised about which valuation figure is used by different lenders as well. And certainly the brokers or the packages having that good conversation in advance with the client about which valuation figure is going to be used, because the lender's also got to consider what is the worst case scenario in this event, and the worst case scenario is default. So who is that property going to be sold to in the event of default? So when you have got larger, more complex structures, or as I use MUFB, but even if they've got individual leases created, if we're lending on a complete block and that loan defaults, we've got an entire block to sell. We are not selling slowly lots and lots of individual leasehold flats. So sometimes a notional value from a client is very much based upon open market value with a long time to sell versus 180-day VPs or something like that might get used.
And Sally, actually, that's a really good, excuse me, that's actually a really good point, that what we, it's died down a bit now, but what we did see over the last 12 months was developers coming to us going, well, I've got these 5 houses and the GDV is X. So the value is X. So I would like to refinance it. And you go, well, no, I think you've got 2 issues there. One is block the aggregate, kind of, you can get that, maybe not on this example, but on others. And the other is the new build premium. You know, the moment you tenant these properties, they're not new builds. They are tenanted. You lose that premium. And we've seen a real disconnect between what they think it's worth and what we can actually lend on. I think that's probably the biggest one we've seen. And we see that even coming, you know, deals come over from our own development team, that, you know, that problem exists. It's something to be aware of.
Thank you. There's a question come in regarding market value. Are there any scenarios where you'd look at the value instead of just solely the purchase price? Chris, we'll stick with you for that one first of all.
Is this where we're saying that the purchase price is below market value, I assume?
Yes. So obviously true BMV is few and far between, but I suppose where there's a discount on it, would you tweak the LTV based on the value as opposed to lending solely against purchase?
So we would always lend on the lower of the two. I think what I have seen in terms of creativity, and which, you know, we're not against, is we've seen some borrowers purchase on a bridge, let up the property, and in letting up the property, we take the view that they've added value, that they've changed they've changed what that property is, and they come to us 3-6 months later once they've tenanted it and go, look, it's now, you know, the investment value or the VP value is X. I would like to lend on it, and we go, yeah, fine. Yeah, we get that, because you've taken some time and some effort and you've put some work in, you've earned some equity in that deal, right? And so their hard cash equity may be 10-15% rather than the 25% if we were doing full LTV, but there's a story there, and, you know, it's earned equity, and we can buy into that.
Thank you. Sally?
Yeah, so Together's business model is very much that we like the clients to have some skin in the game. That's a term that we use quite often at Together. I'm sure I can see you smiling, so you're more than familiar with this skin in the game terminology. So when you've got a client that is purchasing under value, that there's some notional equity in that property that they want us to lend against, rather than them putting any equity in themselves, we're, same as HTB, would lend off the lower of purchase price or valuation. That said, we can do gifted equity. So if it were a property that was transferring from, I don't know, maybe father to son, as long as the purchase price, I'll pick some figures, but say he said you can have it for 150,000. Actually, if the purchase price was set up as 200,000 within gifting the £50,000 worth of the equity, we would be comfortable with that. But if they sold it to him at 150,000, we would then only lend 75% of that 150,000. We're slightly different again with refinance, that we don't lend on kind of some notional increase in the value of the property for the first couple of years. But the reason being, again, is it comes down to this the client having some skin in the game. And what we find it Together, and the reason we have this business model, is because if the client has got hard cash invested in that property themselves, they are far more driven to make that property a successful business, rather than if they've put nothing into it themselves in the first place. What does it matter to them if they throw the keys in the transaction if they didn't have any of their own money invested on day one?
Makes sense. I think the wider industry, you're probably looking, very best case scenario would be 90% of purchase price, subject to that not exceeding normal percentage of valuation. But again, it would come back to the story. Why is this happening? What is the benefit? Is it just because they've negotiated hard with the tenant or with the vendor? And not many lenders will probably take that view. Maybe you're a sitting tenant. Maybe there's something else that they've done to be involved. If there's a story there, you're much more likely to be able to have a conversation.
Yeah, and I think, as we've kind of covered off as well, the reason that you come into Together is because there is something else that's slightly higher risk about that transaction. So when you couple that purchase under market value with some kind of additional risk, it doesn't then make it an attractive case on overall merit.
Jumping to the opposite end, then we talked about applications. So Fiona in advance raised a question about declines. So Chris, we'll jump to you for this one. Anything you can share on the main cause of declines on applications that you're seeing?
Typically, it's the borrower not disclosing something to the broker or us that we have found through the process. So, you know, the source of wealth being from somewhere where perhaps you wouldn't want it to be. It could be another AML or fraud point, and they're the most difficult ones, so you can't disclose those. Or something about the property is not as it was when it was presented at DIP. I think very few deals, if I'm honest, are declined purely just from a credit perspective, because we work with all of our packages, all of our brokers, to educate them so much on what a deal is, and our BDMs talk to those introducers about the deal before they submit the DIP. That really, when something gets to DIP, the only reason it's falling out is because of one of those reasons I mentioned, or actually they've decided to not proceed with the transaction or go elsewhere.
Thank you. It's something that we talk to our brokers and particularly our advisors about. It's that conversation at the start is so key. Rather than just taking down the basics to see whether it fits, as you would do if you were sourcing, for example, the fact find process is as important with specialists as it is with residential. What is the background? As you say, where is that source of wealth coming from? I think something that was talked about earlier was complex income structures. Let's understand the situation and then we can work with it. There aren't many things, fraud aside, there aren't many things in the industry that can't be done. It's about understanding it and finding the right home for that particular deal.
Yeah, I think one of the things I learned the hardest when I first joined specialist lending is that if it's too good to be true, then it is too good to be true. They are not bringing this perfect deal to you that should be going to a clearing bank, etc., because they just love you and they think you're great, right? It is because there is something in the background that either they haven't told you yet or you're about to find out. And so it just comes down to the really, really question them, really dig deep to find out what those things are early on.
Lee?
Yeah, and very similar. I mean, we as a lender, we only get fully packaged business in to us. And sometimes there's a pushback with when we get new packages on board and they'll say, oh, you need us to incur the valuation fee. But we see our packages as an extension really of our underwriting. So I always say, do we lend to that type of client? You've got the answer, yes or no. Is there any issues with their credit? Does it meet affordability? If the answers to all those three things are yes, and the only reason it's going to be declined is because of the security, and we need the valuation to confirm the details of the security. So anything that's valuation piece is usually, it wouldn't be a decline. It wouldn't even have reached us as an application in the first place, or it would be potentially restructured. So we can still lend on that basis, like if we get a cash value, but it will just be a restricted amount of lending. So the only reason, similar to Chris, that we get declines is that something comes out during part of the underwrite process to do with the financial crime risk, I guess, side of things, that would be to do with maybe the source of the deposit, the source of the wealth, not being able to get comfortable around that, or some kind of CFAS alert that you wouldn't be aware of before the application would come into us anyway. It's just part of the additional checks that are done. That say, we do try and support. So if you approach us with a high risk national and a deposit coming from overseas from a high-risk country, I'd also say get us all the information that you can about that before you submit and go for the valuation report, so that our financial crime department can do their searches in advance to a certain point. There's always additional due diligence that then needs to be done when the pack comes in its entirety, but you get an idea from outset as to whether there's any issues of why we wouldn't lend.
Excellent.
Yeah, I mean, we're similar in that respect. If we have a high risk case, and if we think it's especially high risk, or the broker asks us to, we will do the full financial crime due diligence upfront before telling you to go to valuation. Yeah, if that's going to be the biggest concern, we don't want you wasting your time. We don't want the borrower wasting their money. We will do that whole thing up front, because it can be the stumbling block.
There's a top tip for the brokers then is to have those conversations as early as possible, both with the borrower and with the packager that you're working with, in order to make sure that we can mitigate this and make sure we've got the right home for it. No one wants to be...
And that the question is, if someone says I've previously had this case declined, it's saying for what reason? Ask that next question. What was the reason? Because if it was, I don't know, lender doesn't like the property type, then that you can place it for that reason. If it's because, I don't know, lender uncovered some fraud in the background, probably less likely to be placeable anywhere. So
excellent, thank you. So another pre-question we've had from Colin: why do lenders use background debt in affordability when buy-to-let should be self-funding? And not all lenders look at background debts, but Sally, do you want to add anything to that one?
Yeah, so Together we don't assess background personal income, but I understand that many lenders do. What I would also add to that is that it's probably prudent to assess that the property is affordable in the event of void periods. So if you are letting to an experienced investor, they've probably got a fairly solid business plan in place as to what will happen when they experience voids across their portfolio. For your less experienced landlord, just as a broker, be having that conversation with them to say, in the event that they're not achieving the rental income, how would they cover that void period? Would the additional rental yield have been saved for that period of time to make that up? But us personally, we don't assess background income with regards to the affordability calculation.
Thank you, Chris.
Yeah, we're exactly the same. So we look for three ways out on a deal. Effectively, number one is rental income from the property, and that is what we underwrite our deals on. The only time really we're looking at an underlying borrower, kind of UBOs, asset and liabilities, or their income statement, it is around, okay, well, what's the value of the PG if we need to accept that? And to Sally's point, what's the backup here? So okay, you lose the tenant and you're going through a relet period. How are you realistically going to service this debt in the meantime? Do you have a pot of cash sat around? Do you have a job that has sufficient kind of net income on a monthly basis to afford it, or do you have a wider portfolio in the background? So obviously with our portfolio landlords, we're doing a portfolio stress test to understand if the portfolio itself can support voids within it. But yeah, we're certainly not underwriting any of our deals based on borrower income.
Excellent, thank you.
It's also where we scoop. It's probably worth adding, we scoop a few up on that basis, because there's many lenders that also then have background minimum income requirements in order to enter the buy-to-let market. So that can cause some headaches even when you're looking at mainstream lending initially.
And again, I think this loops back to a point that was brought up earlier about landlords exiting the market. I think when interest rates are really low and you're getting a nice monthly income from the property that you're dealing with, things look rosy and it's great. But the minute that the interest rate increases, maybe the boiler goes at the property, there's some additional work that needs to be done, and it doesn't seem as lucrative monthly anymore. So from a lender point of view, what is that strength moving forward? Is this someone, as soon as there's no tenant there, they're in arrears in month one, or is there something else in the background that can support that? So we've had two other questions just jump through, so thank you for these. One of the most popular ones we've had for questions so far, so thank you guys, the content's been great so far. Ian has said, I've got a client who is split from her partner, kept the property, but he's now struggling with the bills, so he's looking to move back in with mum and dad and would like to rent out the property. I assume she would be classed as a non-resi first-time landlord, so would I need a specialist lender for this? Specialist lenders could certainly do the transaction. Chris, do you want to weigh in on that?
I think I'm right in understanding here that he's lived in the property and is therefore moving out, so it'd be a regulated buy-to-let contract, and therefore that's out of scope for us. So not something that we would do personally.
Sorry.
Well, lucky you got Together on board, because we would scoop that up. No, we've got a consumer buy-to-let product range. The only other question I would ask is whether or not they do own any other buy-to-lets in the background, because even though they have lived in that property, if they've got other buy-to-lets, they could fall outside of that regulatory criteria by being classed as having been a more experienced investor. But yeah, we could lend on that basis, and it would be specifically based on rental income alone for purposes of affordability.
Yeah, certainly from a consumer buy-to-let basis, there are a number of specialist lenders that would consider that. So, Ian, that's certainly a deal that we'd be able to take a look at for you. And as you've heard here, we've got a home for that as well. Second question: foreign national buying an investment property, bought it using a bridge. Once purchased, how long before being able to remortgage that with HDB altogether? And what would be the ICR? Sally, as you're on the screen, do you want to pick that one up first?
Yeah, I can remortgage it with us on day one if that property's tenanted or able to be tenanted within the next 30 days. And for a foreign national, I'm assuming living overseas and not foreign national living in the UK taxpayer, then it would be stressed at 125% ICR.
Thank you. Chris, you on the spot with criteria now?
Yeah, same as Sally. So yeah, we would fund that from day one. Our ICRs, they're available on our website to have a look at. They depend on I won't go through them all, but they depend on kind of the property type, etc., more than the individual.
Again, perfect examples there of solutions that can be found for specialist deals, where brokers might not know where to turn initially. So by all means, speak to our mortgage desk, have the conversation, and we can tell you within a couple of minutes as to whether that's something that we can do and where that would look like. So one thing, just Chris, to pick up on from a point you mentioned earlier, the high fee product, and this is something that raises questions with a number of brokers, and we've had this raised on a couple of webinars previously. The product seems to be quite popular with buy-to-let landlords in particular. Can you shed any light on kind of the reasoning behind that, where the product came from?
The product came from demand from our brokers. Really, they were calling out for it. Obviously, it was born out of the rate shock that we went through, where we were able to. So to be clear, all of our products, no matter what the fee structure, have an identical lifetime cost. So there is no difference to a borrower over the lifetime of the loan in terms of pounds and pence, no matter which fee structure they take. And ditto, we make no more or less money depending on which product you take. So obviously, it's the flip side. So really, it's just down to borrower preference. So I can only really assume from that and from the conversations with our brokers that it's because either in the early days, it allowed them the affordability to refinance, to get out of maybe a contract that they didn't want to be in at the time. And now I think it's unlocking higher levels of leverage. Really, so someone that maybe still has a relatively lower yielding property, maybe they could only achieve sort of 70% loan to value on a lower fee product. We'll take the higher fee product to access that extra 5% leverage, typically because they want equity release and they can see opportunities in the market right now. So I think the customer need has changed. Hard to prove that in the data, but the demand is still there.
Just an approach to maximizing that yield coming back from the property in difficult times. And Sally, Together looked at a similar thing with the top slicing element. How are you finding that that's gone down with borrowers? Yeah,
so we do top slicing still, but we do that with we'll proceed with caution with regards to top slicing, which I think is just it's been prudent, it's been sensible in the current market that if you are utilising clients' outside income, there's a potential impact on them moving forward if they wanted to do something with their personal finances or their main regulated mortgage arrangement. So we don't have a product in the way that HTB do with regards to a higher fee and a lower rate on there. What I would say with Together though is because we're not at the high end loan to value end of the market, that there's potentially less issues with rental yield because the clients aren't maximised on their borrowing from a loan to value basis. That's not to say that all of them fit on a rental yield basis, and top slicing can be considered where it is appropriate. But we only do top slicing within certain parameters. So there's a minimum income requirement, and there's also different levels depending on level of experience you've got as a landlord.
They're both really good examples of that innovation that specialist finance can bring, rather than just it's this. Well, how else can we make that fit, and where are the benefits? So looking ahead then to the rest of the year, landlords seem to be hit with ever-changing legislation. If you were able to bring in or change any legislation to help the buy-to-let sector, what would you pick and why? Sally, do you want to take that one first, as you're on my screen currently?
Yeah, I would rewind one that's now pretty old, but the taxation, the loss of interest rate tax relief, to completely unwind that and allow people to offset their entire mortgage payment again from their rental income. We acknowledge that we've talked a lot today on this call about it currently being a space for the more professional landlords, but in the same way that I'm saying all of us specialist lenders are playing nicely, it's nice for landlords to play nicely in the sector as well. And I think what's happened is that there's some smaller landlords that were still professional landlords, but maybe with a smaller portfolio, that have been impacted to the point where they've had to leave, that are now not able to realise long-term property ambitions. And it would be nice that property ambitions for buy-to-let landlords were more accessible to all. I mean, nowadays many purchases are made within a limited company, but the reason that people have had to leave is either because in order to transfer it into a limited company, they're hit with the additional stamp duty cost or whatever it be. So yeah, it's a shame that smaller sole named landlords are hit by all of the legislation, and I think that was a massive piece that I would like to have seen gone, for personal reasons as well.
Thank you. Chris, how about you?
I'm going to do a bit of a cop-out and say that I think landlords want more than anything just a bit of certainty. It's the flip-flopping that has gone on for so long, that means you can't actually make a decent investment decision. So yeah, I'll go back to it. Not everyone being dramatic, but a lot of people piled into service accommodation and holiday lets because of the tax benefits of doing so. That gets taken away. Well, okay, fine. A lot of people invested quite a lot of money in improving the EPCs for their properties because they thought that, the new EPC legislation was coming in. That got taken away. The decent home standard has been hanging around for years now. I think it was first kind of looked at in 2021. That's hanging over landlords. I think they just need a really clear flight path. And to be clear, I'm not entirely sure that a new government will necessarily provide this, but a really clear flight path in terms of what the future looks like. What does the next 5 or 10 years look like, so that they can make decisions. Property is relatively unique as an asset class in that it has huge costs to entry. You can buy and sell a share or put some money into a savings account relatively cheaply, and take it in and out relatively cheaply. But the costs and barriers to entry for investment are large, and therefore this is a really long-term view. And I think borrowers just want to know what they're getting themselves into, and to know that yield that they are getting, the cost base, the regulatory base, the reporting requirements, whatever they are, they know that up front and they can make that informed decision. And I think at the moment they don't have that.
Interesting points. Thank you. That brings us to the end. That's the hour flown by very quickly. So thank you for that. It would be remiss of me not to give you an opportunity to promote yourselves to our brokers that are attending. So Chris, anything you'd like to say to the brokers that are on the call today?
Where do I start? Look, so we are a true specialist lender. I think that's come across really clear during this conversation. If you have a deal that is true, is specialist in terms of the asset, in terms of the borrower, etc., there is a broad church of lenders out there. I think what really sets us apart is the quality of our service, so not just the speed, but the quality of the service and the people that you will engage with when working with us. I was just looking at our service scores. I think from the beginning of the year, no individual broker on a deal has given us less than 10 out of 10 for our service from completions. So it really is ringing true this year. And also that ability to pick the phone up to someone, right, to do the problem solving, to innovate a new product, or to take a view on criteria. That's really where I think we stand out from the crowd.
Service is something that can't be underestimated in the industry. So it's really good to hear that you're delivering that, and people are seeing it as well, which is good. Thank you, Sally.
Yeah, I mean, we're very similar in nature to what Chris is saying. We're a relationship-based lender. We do have branding all over the place about being a common sense lender. So even though we do have criteria, there's always a person to discuss a case with. So there's flexibility within that criteria, and we assess a case on overall merit. So even if it's outside on one thing, if it's good overall in many other areas, it's having that person to speak to. So it's thinking about us things that are not your average, really. So anything that is not your average client, not your average income, not your average property, not your average transaction, but just don't close the door on a case. Have a conversation with Crystal, and you can support a lot of your clients' property ambitions on cases where historically you've maybe had the opinion that you can't.
Excellent. And I think sometimes there's a perception that high rates sometimes means a drop in another area. But certainly with the two lenders on the call today, that that's not the case. The products are great, innovative, flexible. The people you deal with are always pleasant, always get the answer that you want. And that service piece that you do really feel, and I've mentioned it a few times, but that's really important to us as a packager. The fact that if we're dealing with a lender, we need that certainty that the deal's going to go through, and that when you do pick up the phone and speak to someone, you're going to get the answer that you want. You're going to get that delivery. So certainly thank you for the answers that you've put through today. There's been some really good topics brought up, some really good questions as well. There's a couple that I'll take off air and respond to. But no, brilliant. Thank you. It brings us to the end of the session. So Chris, Sally, thank you for your time and more importantly for your expertise today. Attendees, I hope you have all found that useful now and see more of a plan B for your clients. If any of the topics today have given you the spark to help some of your customers with buy-to-let, please contact our mortgage desk. The number's on the screen at the moment. 01827 337710. We'll be more than happy to talk through any scenarios that you have, anything that can make its way to HTB and Together particularly encouraged today. Keep an eye out on your emails, both for the next session and also for the CPD certificate that we'll be sending out shortly. And for me, thank you, Sally. Thank you, Chris.
Thanks for having us.
Yeah.
And thank you for joining me. Stay busy, stay safe, and see you all again soon. Thank you.